In this video, we will explore the concept of fundamental analysis and how it applies to both the equity and commodity markets. We start by looking at the core philosophy of valuation. Imagine a weighing scale. On one side, you have the market price, which is what the stock is trading for right now. This is often driven by short-term technical volatility and market noise. On the other side, you have the intrinsic value. This is the true underlying worth of the company, driven by long-term fundamental cash flows and profits. Your goal as an investor is to compare these two. If the market price is less than the intrinsic value, the stock is undervalued, making it an attractive investment. However, if the market price is greater than the intrinsic value, it is overvalued and you should sell or avoid it. This philosophy actually contradicts the efficient market hypothesis, which claims that prices are always correct. Fundamental analysts believe prices can be wrong, and that is where the profit opportunity lies. To find this intrinsic value, we use a structured method called the top-down approach. Imagine a funnel. At the very top, we start with economic analysis. Here, you analyze the big picture, looking at cyclical and secular macroeconomic trends to understand the overall environment. Once you understand the economy, you move down to industry analysis. Here, you assess the intensity of competition and how companies are positioned within that specific sector. Finally, at the bottom of the funnel, you perform company analysis. This is where you dig into the specific details like cost structure, financial strength, management capabilities, and governance structure. While some investors rely on qualitative factors, others prefer a purely mathematical route called quantitative research. This is the data-driven approach. It focuses entirely on underlying data, finance, and operational metrics. Analysts use tools like time series analysis to look at trends over time and regression of historical data to predict the future. They also run sensitivity analysis and simulations to test different scenarios. These metrics serve as leading indicators. However, you must be aware of critical limitations. Past data is often less useful because accounting standards change, business models shift, and comparable information might not be available. Markets are not always logical because they are run by humans. This brings us to the behavioral approach to equity investing. In theory, investors make optimal choices based on information analysis. But in reality, decisions are often suboptimal. The cycle usually starts with information analysis, but then behavioral biases kick in. Emotions like fear and greed influence the decision maker. This leads to a price divergence from fair value. Understanding that markets are driven by these psychological factors helps you understand why prices sometimes do not make sense mathematically. Now, let us shift our focus to fundamental analysis in the commodity market. Here, price is determined by a tug of war between supply factors and demand factors. On the left side, supply is driven by production from farms, mines, and wells. It is also heavily affected by weather, such as droughts or floods, government policies like tariffs, and geopolitics like wars or sanctions. Input costs like energy and wages also matter. On the right side, demand is driven by global economic growth or GDP. Other factors include demographics, urbanization, and seasonality, like winter heating needs or festive buying. We also see the substitution effect and changing preferences, such as the shift towards electric vehicles. To analyze commodities, we need to watch three key macroeconomic indicators. First is inflation. Commodities like gold and silver often act as a hedge against inflation, meaning their value tends to rise when the cost of living goes up. Second is interest rates. There is generally an inverse relationship here. Higher interest rates usually lead to a stronger US dollar, which in turn leads to lower commodity prices. Third is trade and industry data. We look at numbers like the Purchasing Managers Index or PMI and industrial data because they directly drive the demand for metals and energy. Let us look at a specific case study for bullion, specifically gold. Gold is unique because it acts as an inflation hedge, a store of value, and a safe haven asset. If we look at the demand by sector, jewelry makes up the largest chunk at 47%, investments account for 24%, and central banks hold 23%. Technology uses only 6%. Geographically, the top producers are countries like China, Australia, and Russia. The top consumers are China and India. It is important to remember that gold typically carries an inverse relationship with stocks, bonds, and currencies. So, what drives the price of gold up or down? Positive impacts that push prices up include an expansionary monetary policy where rates are cut, a weaker US dollar, and higher inflation. Strong demand and buying by central banks or ETFs also boost prices. Fear in the stock market, known as a bear market, also drives people to gold. Conversely, negative impacts that push prices down include contracting monetary policy with rate hikes, a stronger dollar, and lower inflation. If supply is higher than demand or if there is selling by central banks, prices will fall. Now, let us look at the energy sector, specifically crude oil. This is often called the mother of global financial markets or black gold. There are two main benchmarks you need to know. WTI or West Texas Intermediate is explored in the US. It is high quality with a sulfur content of 0.24% and trades on NYMEX. Then there is Brent oil, which comes from the North Sea in Europe. It is the global benchmark with a sulfur content of 0.4% and trades on ICE. Oil is used for fuel, plastics, lubricants, and bitumen. The group known as OPEC influences this market significantly as they control about 40% of production and 75% of reserves. The price driving factors for crude oil are quite dynamic. Prices tend to go up when OPEC limits production or when US activity falls, such as a drop in rig counts or inventory. A weaker US dollar and an expanding economy also boost prices. Political instability in the Middle East or hurricanes can also cause price spikes. On the other hand, prices tend to go down if OPEC increases production, US rig counts rise, or the US dollar strengthens. An economic contraction or stable political conditions generally lead to lower prices. It is crucial to understand the impact of commodity markets on the equity market. A rise in commodity prices leads to increased input costs for companies. This usually results in reduced profit margins. However, the impact depends on who you are. In scenario A, we have the users like airlines and logistics companies. For them, high input costs mean lower profitability, so their stock prices might fall. In scenario B, we have the producers like oil producing companies. For them, the high price means improved profitability, so their stock prices might rise. Also, remember that commodity prices signal global demand. For example, a fall in copper prices often signals slowing industrial demand. Finally, let us wrap up with the broader economics and learning objectives. Economics is essentially the study of choices under conditions of scarcity. The core assumption is that people are rational and face trade-offs. We divide this field into two sections. Microeconomics is the study at the firm or individual level. Macroeconomics is the study at the societal or broad scale. As we conclude this topic, You should now have a checklist of objectives covered, including the principles of micro and macroeconomics, sources of economic data, key variables for analysis, and the difference between cyclical and secular trends